Welcome to Chartered Accountants Academy video. Today what we're going to be covering is taxation. And our main learning outcome for today will be understanding the special provisions that accrue to miners, which are namely the capital. So when we look at mining, these are assessed like any other taxpayers. There is no special income tax act that applies to miners. They get application of your Section 8 and Section 15 and the same for miners. The only difference with miners is that they have a special capital allowances that they can claim that are different from other taxpayers. So rather than having your normal special initial allowance or wear and tear, you have your what we call your capital retention allowance when it comes to mining. And another important point is that your 6-year assessed losses, when it comes to miners, these are done away with, and miners do not have a limit as how long they can carry their assessed losses for. A good question to ask yourself is, why would this be, and what's the reason behind giving miners a longer period in which to carry an assessed loss? Good food for thought. So what are the relevant sections that we need to look at? Obviously, we need to define what a mining is, or what mining operation is. Once we've done that, we'll also look at Section 8 when it comes to recoupment. But recoupments can only be understood after looking at your capital retention allowance under Section 15(2)(f). You also have prospecting expenses that are allowable deductions as far as mining is concerned, which is different from all your other operations. So as we said, we need to understand what mining is. What is the definition of mining as far as Section 2 is concerned? Here, go look up at the definition in your legislation, but it basically reads as this: minerals that Section 2, in terms of Section 2, a mineral includes any valuable crystalline or earthy substance forming part of or found within the Earth's surface and produced or deposited there by natural agencies, but does not include petroleum or any clay or other fire clay, gravel, sand, stone, or other than limestone, or other like substance ordinarily won by the method of surface working known as quarrying. So what is a mining operation? Again, according to Section 2, a mining operation includes any operation for the purpose of winning a mineral from the earth, the subsequent smelting and refining by the same taxpayer of that mineral won from the earth, and any other operation recognized by the commissioner, such as the reworking of mine dumps. So now that we understand what mining is, in other words, it's the winning of minerals, and we know what minerals are because they've been defined in the Act. What kind of minerals we're talking about? Your gold, zinc, platinum. These are the minerals we're talking about. Sand, gravel, stone, clay, other than, of course, limestone, all are not minerals because these are won through a method called quarrying. With mines, we need to be looking at actual winning from the earth, from within the earth surface. So next, what are we looking at? We're talking about your prospecting expenses. These are under Section 51, Section 15(2)(f), subparagraph 2. So this refers to expenditure incurred by a person on operations either in searching for a potential claim or in searching for minerals after a claim has been pegged. Obviously, there needs to be a binding election which is available for the mining company that to claim such an expenditure from the current income from any source or carry forward the expenditure to be allowed against income from mining operations in any subsequent year. So what this basically means is that for mining, once you have expended money on prospecting, given that you expend money on prospecting over, say, a long period in time, you can actually carry forward that expense to the year you actually start making income so as to reduce your taxable income. This is part of tax planning. When you're a tax practitioner, especially working for a mine, these are kind of expenses you need to look at and how best to claim that such expenditure. Do you claim it in the first year you incur it, or you'd rather carry it forward to the year when you start making profits and then claim the expenditure so as to reduce your taxable income in the year you actually make certain profits. So such expenditure in terms of prospecting may include the surveying costs, sinking bores, digging of trenches and pits, and any other prospecting and any other exploratory works undertaken for the purpose of acquiring the rights to a mine minerals. Now we look at what is a capital retention allowance. This again is covered under section 15.2, but this time is subparagraph 1. And also we need to look at the fee schedule, which gives us more depth as far as your capital retention allowance are concerned. So capital retention allowance, this is basically an allowance similar to your capital allowances given to other business entities. So you're similar to your special initial allowance and wear and tear allowances. But for mines, we are given what we call a capital redemption allowance, and it's basically expenditure of a capital nature that a mine does. And in this slide, we further explain as far as we're concerned, when we talk about capital redemption allowance, the expenditures we're looking at are expenditures like buildings, works or equipment, lease premiums, shaft sinking, expenditure incurred prior to the commencement of trade for the preliminary surveys of bores, development, general administration, management, interest on loans, and expenditure incurred on or after the 1st of April 1988 on any permanent building used for the purpose of mine, schools, nursing homes, and clinics. Note that the capital expenditure does not include cost of claims and goodwill or company flotation expenses. So in other words, when you have capital expenditure for the purpose of your CRA, these are the expenses that are included or are taken into consideration. Now, when we're looking at our capital retention allowance, there are important things to note. The four items that are included in calculating your capital retention allowance are firstly the current capital expenditure, which is basically the amount of capital expenditure incurred in the current year, your unredeemed balance of current capital expenditure. This is the balance of capital expenditure not extinguished by the CRA, and pre-production expenses also form part of your unredeemed balance when production commences. And we look at recoupment, which is the amount accruing from the sale, damage, destruction, or other disposal of an asset of which capital retention allowance or an allowance on replacement of the asset has been claimed. It does not include, in the case of damage or destruction of an asset, an amount exceeding the original cost. And also you have life of the mine, the number of estimated useful life for that mine based on the amount of ore that's in it. So it's mainly an estimate. Those are the four items that we need to look at when we're looking at our capital retention allowance. Hope you understand them. So we're talking about CCE, which is the current expenditure for the year, your UBCE, which is the unredeemed balance. So when you work out your capital retention allowance, as far as the current capital expenditure is concerned, not all of it might be extinguished. And that amount that is not extinguished can be carried forward as your unredeemed balance. And that's what your UBC is. And recoupment, as usual, you know what recoupment is. We've gone through this when you went through our capital allowances and section 8. So we have several methods for working out our capital retention allowance, specifically 3. First one is the life of mine method, then we have a mixed method, and you have a new mine method. So as can be seen, the two primary ones are your life of mine and the new mine method, and a mixed method is a combination of life of mine and new mine. And it again is an election, so it's up to the taxpayer to elect which method they want to use as far as calculating your capital retention allowance is concerned. Therefore, again, because it's an election, what should be ringing in your head is tax planning. So how do you work out the life of mine method? So this is covered obviously in the 5th schedule and it's period 2. So your life of mine method takes your CCE, your current capital expenditure, you add the unredeemed portion from last year, less any recoupments in the current year, all divided by the estimate of the life of years. Now, what you need to note is that estimate of life obviously is based on the type of material and will be the amount not exceeding when it comes to zinc and lead minerals 10 years, when it comes to iron 5 years, and for all other types of minerals it should be a period not exceeding 20 years. So the taxpayer note is the one who estimates the life of the mine and submits it to the commissioner for approval. But it should not exceed those limits I've told you. If it's zinc and lead, 10 years. If it's iron, 5 years. And any other minerals are 20 years. Note you can also, after using the life of mine, you can subsequently change to a mixed method. You cannot then use the new mine method. Once you've elected the life of mine, you can subsequently obviously change to the mixed method, but you cannot go back to the new mine method. So let's look at an example of your life of mine. So a company had an unredeemed balance of capital expenditure of 200,000 as at 1 January 2013. His current capital expenditure for 2013 was 120,000. And during the year, the company sold a machine worth 40,000. So the mine estimates the life of the mine to be 4 years from the end of the year of assessment. So from the end of 31 December 2013, he estimates that he's got 4 more years as far as this mine is concerned. So how do you work out a capital retention allowance? Again, you take your UBCE, which is 200,000, less your recoupment, which is 40, so you get 160. Add to that your current capital expenditure, which is 120, which will give you a 280. Then you divide all of that by the life of the mine. In this case, is 5 years, including that current year we're actually working with. That's why the life of mine will be 5. And you find that your capital retention allowance for such a company will be 56,000. How about the new mine method? So this method is only available to those carrying on operations in a new mine as defined. This method allows the taxpayer to deduct all, please I reiterate, all of the capital expenditure brought forward and the current in the first year of production. Thereafter, capital expenditure is allowed in the year in which it is incurred. So in other words, you can only deduct carry forward in the first year, and thereafter, obviously because you've deducted all the carry forward, in the next following years or subsequent years, the current capital expenditure will all be allowed as a allowable deduction under the allowance of capital retention allowance. A new mine is defined as an undertaking which commenced regular production on or after 1 April 1968, or recommencement of a mine which has changed ownership and has been reorganized with substantially new development and new plant. So basically our CAR here is your current capital expenditure plus your unredeemed capital expenditure less any recoupment will be equal to your capital retention allowance under the new mine method. So for capital retention allowance, there are certain assets that have restrictions as far as the amount of capital expenditure that you're allowed to actually deduct. So with these restrictions, you look at first and foremost your PMVs. These are restricted to 10,000, just like your normal capital allowances. PMVs are restricted to a minimum of 10,000 that is allowed to be deducted, a maximum of 10,000. For staff housing, if we're coming to capital retention allowance, you're allowed 10,000 on a building which is mainly used as dwelling by individual shareholder, where he or she is one of not more than 4 individuals who control the company, where the building was erected on or after, obviously, the 1st of January 2009. For your nursing homes, schools, clinics, and hospitals, you're allowed up to a maximum of 50,000 in respect of that building. There's no restriction when it comes to the dwellings of mining employees. You're allowed to deduct the full amount for any structures that are put up or bought for your mine employees. But when it comes to your schools, hospitals, and nursing homes, again, you're allowed only a maximum of 50,000. Now, as far as recoupment is concerned, I think I gave you a quick definition of what recoupment is. So these are generally the proceeds you get from disposal as far as mining is concerned. Whatever amount you recover from insurance proceeds when it comes to damages or destruction of that building, less any, of course, deductions that have been claimed. Restrictions, if the asset is sold, has been subject to a limit, again, as you do with capital allowances, you'll need to do a proportionate amount as far as the recoupment is concerned. Just like you do with PMVs under your normal capital allowances, it's the same thing you do when it comes to a mine. So in quick example, if a motor vehicle is sold for 20,000, a motor vehicle that was acquired for 20 is sold for 15. So we need to do the proportion here. If when I bought the vehicle, I was only restricted to 10,000, what now when I sell the vehicle for 15? What portion of that 15 is actual recoupment for the 10,000 I was allowed as a deduction? So what we do there is saying 15,000 times the 10,000 divided by the 20,000, which will give us a recoupment of 7,500. I hope you understand that. It's the same proportion we've done when we're doing capital allowances. This works for all assets that have a restriction. Now, I'll give you a quick example. Here, during the year ended 31 December 2012, a company or mining company incurred the following capital expenditures. So it built a school for 70,000. Also in there for that school, it had a teacher's house for 60,000. Then our finance director, we built him a house for 80,000 and also built a staff canteen of 120. Question is now, using the new mine method, let's calculate our CAR. In our new mine method, remember all current capital expenditure is allowed as a deduction as part of the CAR. So our school building, remember we have a restriction on school building up to a maximum of 50,000. For the teacher's house, again, because it's part of a school building and is part of the definition of a school building, again, we're allowed a maximum of 50,000. For the finance director's house, because there was only one, we have not been mentioned how many others there are, and he doesn't have ownership, or we don't have enough information whether he's part of owners, we will allow the full amount of the 80,000. And for the staff canteen, again, because it's a building that has been erected on the mine, the full amount of the 120 will be allowed. So as far as the new mine method is concerned, in this case, our capital redemption allowance will be equal to 300,000. Where assets are transferred between companies under the same control, or between husband and wife, or in a scheme of localization, if the taxpayer so elects, the amount of capital expenditure ranking for redemption in the hands of the transferor at the time of the transfer is made shall rank as capital expenditure for redemption in the hands of the transferee and will be deemed to be recoupment from capital expenditure in the hands of the transferor. In basic English, all we're saying is if company A, the parent, then transfers the mine to company B, the subsidiary, in this case, the amount of which the assets are being transferred to company B will be up for capital retention allowance. And as far as the transfer is concerned, that amount will also be recoupment, will also be included in their gross income, whereas he will be allowed to deduct for tax purposes the capital retention allowance. That is basically what we're saying. If two companies that are under the same control transfer assets between each other. The value of those assets will be either included for as far as the person receiving the assets concerned can be included in the capital redemption allowance calculation. And for the person who is doing the transferring or handing over of the assets, you also have a recoupment that can be calculated for his gross income purposes. So if there are any questions, please feel free to bring them to class when we're doing mining. Make sure you're using this video lecture alongside your module and your legislation handbook. And please attempt the end of unit question and come preloaded with any questions to class. Thank you and good luck with your studies.